Continuing topic 4 of paper 3, covering conduct of business, we're now going to look at the Code of Conduct general principles that are categorized with regard to clients. And the first one, general principle 4, information about clients, the classic KYC requirements. Know your client. We'll also look at client agreements and discretionary accounts. And I would highlight that client agreements, that material is often appearing in the exams. So know your client. The licensed registered person should establish clients' true and full identity, their financial situation, strength, their investment experience, and their investment objectives. You want to know about your client. The idea behind this is to improve transparency. Now, where the SFC requests identity information of the ultimate client, then you've got to give it to them within 2 business days. And you should take reasonable steps to establish true and full identity of any third party in respect of a client account. The recommendations you make to the client should be suitable given their circumstances. Now, this is Code of Conduct material that you may have seen in other papers. It's exactly the same. And when a client without knowledge of derivatives wish to invest, then you or the intermediary should explain those risks to the client. Moving on to client agreements. You should enter into a written client agreement before providing any services. The agreement should be in Chinese or English, and that's at the option of the client. Attention to relevant risks should be drawn to the client. And if there is a face-to-face meeting with the client, rather, if a face-to-face meeting does not take place, then a copy of the agreement should be provided to the client and steps taken to verify the client's signature. Now, there's a lot more material on that, and we'll come to that shortly. Now, on page 4.10, we've got all the items that should be included in client agreements. And it's from this list that I've seen questions previously. So be aware of what's in here. Some of them are not the ones that they'll examine. For example, full names and addresses. I think that's fairly straightforward and obvious. You've got to undertake to notify material changes of information to each other. That's stated in the agreement. Full description of services. Now, we get into some specific points. Full explanation of the margin procedures, circumstance under which client's position may be closed without the client's consent, and a statement that a report may be made to the Hong Kong Futures Exchange and the SFC if margins are not paid on time. So that's very specific to a futures trading agreement. Statement that the licensed person will provide the client upon request with products, specifications, and prospectuses. Fine. Here's another one that I've seen come up, an explanation that if the client suffers loss because the intermediary defaults, now what happens in that instance is that the client can claim from the investor compensation fund. But what this point is saying is that the liability of the compensation fund will be limited, and accordingly there can be no assurance that all the loss will be recouped. Now, the limit is stated with regard to the investor compensation fund. A statement that trades are subject to the rules of the futures exchange, including client's identity, will be disclosed if it's requested by the futures exchange, and the futures exchange may also limit positions or close out contracts if the client trading affects fair and orderly operation in the market. So these points that I'm highlighting are very specific to paper 3 and futures trading. Then next point, a statement prominently displayed in bold type that the intermediary may take the opposite position to the client's order, provided the opposing trade is executed competitively on or through facilities of the futures exchange. Again, very specific point with regard to futures client agreements. Clarification that with regard to any account that the intermediary maintains with the clearinghouse as principal, so the intermediary's principal, then any assets lodged with the clearinghouse as principal for such an account are not held in trust for the client. In other words, they will not use client assets as assets lodged with the clearinghouse. And then we're told from 9 June 2017, Code of Conduct requires clause stating any financial products listed for sale or recommended will be suitable for the client. So you've got to state this, rather the intermediary's got to state this in the client agreement, saying that any product that they're recommending must be suitable for the client. No provision in the client agreement should be inconsistent with the code of conduct. There should be appropriate risk disclosure statements. We'll look at those in a moment. And the client agreements should not remove, exclude, restrict the legal rights of a client or legal obligations of the licensed registered person. Now, I've taken a bit of time to go through all those points simply because I've seen questions covering what should be in a client agreement. So be aware of those points. Moving on, as I said, to risk disclosure statements. Now, there's a large paragraph that they recommend you should put in a client agreement. I'm not going to read it all, but I recommend that you do. The risk of loss in trading futures contracts or options is substantial. In other words, you can lose a lot of money trading futures and options because the prices move very quickly. Read that paragraph. They don't examine the paragraph in whole, in total, but they have set questions that are digging into some of these points that are included in the paragraph. And then we have additional risk disclosures with regard to futures and options and risks that are common to futures and options. They're all listed there. Now, the non-face-to-face approach, you don't meet the client, but they want to open an account, then you've got to verify their identity. If you cannot, then documents should be certified by appropriate person. They list the appropriate persons. Intermediary can cash a client's check. This is the classic, at least 10,000 Hong Kong dollars to check identity and signature. And obviously you'll compare the signature on the $10,000 check to that on the client agreement. Now, recently they've added more material with regard to non-face-to-face approach, with regard to top of page 4.12, online onboarding of clients using a Hong Kong bank account and remote onboarding of overseas individual clients. A lot of detail there, not regularly examined by any means. I would read through it, but I'm not going to highlight any specific points there. Discretionary accounts. A discretionary account is where the intermediary acts without the client's prior approval for each transaction. And the Code of Conduct says that there is a number of items they impose with regard to discretionary accounts, and they're listed there. Client's authority should be in writing, etc., etc. You can read that as well as I can. Now, I would highlight the next few points because this again is specific to paper 3, and it reads middle of the page: additional requirements for Hong Kong Futures Exchange participants. The exchange participants are licensed corporations, registered institutions that are participants of the exchange. They have the right to use the trading systems directly. Those participants who want to trade futures and options via a discretionary account. Okay, specific points. Intermediaries required to notify the client if the net equity, and we'll consider what that is in a moment, falls by more than 50% or falls below a sum specified in writing by the client in any period of 3 days or less. Remember, the intermediary does not have to get permission for every transaction to a client. But if this net equity falls by more than 50%, then they must inform the client. The net equity, let's look at the asterisked point at the bottom, is the balance shown in discretionary account ledger plus floating profits minus floating losses minus adjustments for levies or commission due from the client. Okay, are you going to get examined on what net equity represents? Highly unlikely, but you may be examined on the fact that if the net equity falls by more than 50%, you got to notify the client. Then on top of that, no new trades may be initiated without the prior written approval of the client until the net equity exceeds. In other words, if you've gone below 50%, then it ceases being a discretionary account. You've got to get prior written approval of the client. And the third point, no more than 2 day trades. When you're operating a discretionary account, no more than 2 day trades may be executed in any market. No short option positions may be opened. So you can't sell options unless client has given prior written approval for such transactions. So again, that's where the discretionary aspect falls away. You must get prior written approval. Moving on to professional investors, 3.2. Now, this material is in other papers, very, very standard. They identify who professional investors are, and then they identify waivers applicable to professional investors, areas of the code of conduct that you do not have to cover. When identifying the professional investors, 3 categories at the bottom of page 4.13: institutional professional investors, corporate professional investors, and individual professional investors. Now, the identity of institutional professional investors, which is covered at the top of page 4.14 under paragraph 321, that's institutional professional investors, they are outlined in the Securities and Futures Ordinance. And these are all the big classic institutions who are considered professional investors. Whereas corporate professional investors and individual professional investors are defined in the professional investor rules. Now, they used to examine the fact that corporate professional investors are not stipulated in the Securities and Futures Ordinance, but I haven't seen questions like that for a long, long time. But I'm just pointing out the SFO gives us institutional professional investors, and the rules gives us corporate professional investors, the definition, and individual professional investors, the definition. And just moving straight to individual professional investors, high net worth individuals have a portfolio of not less than 8 million Hong Kong dollars. So that's just over $1 million US dollars, which is not much these days. And when you're taking into account the portfolio, you include the portfolio of spouses and children where they're jointly held, not siblings, not parents. And I mention that because they have examined that point. So when deciding if someone qualifies as an individual professional investor, it's a portfolio of not less than 8 million Hong Kong dollars. Portfolio is held by a corporation which is wholly owned by the individual. That also qualifies. Okay, that's the identity of who professional investors are. Then we come to the waivers. The things that you don't have to do with regard to professional investors. And the SFO provisions that are not applicable, the unsolicited call, in other words, you can cold call a professional investor, requirements for offers by intermediaries. We don't need to worry about that. And those exemptions apply to all 3 categories of professional investors. Then we go into sort of a whole host of combinations of waivers. Now, what we've done is page 4.15, you see at the top, non-applicable code of conduct requirements. Information for clients, and we've listed the details there. And then just underneath point 5, very important guidance, all above exemptions apply to institutional professional investors, corporate professional investors, but there's only selected 1, 2, and 4 apply to individuals. Information about clients, the need to establish the client's financial situation, etc., the 3 points that are listed. Those exemptions apply to institutional and corporate PIs, not individual. C, the client agreement, the need to enter into a client agreement and provide risk disclosure statements. You don't have to do that to institutional professional investors and corporates. You do for individuals, but there is extra requirements there. You must get the agreement of the professional investors concerned. Discretionary accounts, the need to obtain client's prior authority, need to explain written authority, etc. You don't have to do that for institutional professional investors and corporate professional investors. So we then, top of page 4.16, look at the different categories and some qualifications. Institutional professional investors automatically exempted from all those requirements. So yeah, they don't need the same level of care, as it were, because they know what they're doing, or supposedly. Corporate PIs and individual PIs, to apply the exemptions, licensed registered person must write, here we go, here's the qualification, write to client explaining consequence of risk being treated as a professional investor, information that will not be received, and the fact that they have the right to withdraw from being treated as a professional investor, obtain written signed declaration from the person that he or she has provided with the above explanations, and carry out confirmation exercise annually. And when those are complied with, they're exempt from complying with A1, 2, and 4 on the previous page. And then for corporate PIs only, the licensed registered person to apply the waivers must be satisfied that there's an appropriate corporate structure, appropriate investment process and controls, that they operate as a sort of informed professional investor. And if those points are covered, then the corporate PI is exempt from all conduct requirements that we've listed.